Bank of England increases base rates. Again, what does it mean for borrowers? So, welcome to Market Wrap number 145. Stuart Williamson here at the helm. Our weekly jog around the news reports, stories, topics to see what's useful for our clients to help make buying decisions, and potential clients, of course. In summary, this week we look at the recent Bank of England rate increase and what it means, plus what is the next buy-to-let investment opportunity out there, and has the race of space completely been reversed? So, Market Wrap 145, welcome. Interest rates rise again. The Bank of England increased interest rates one more notch this week from 4% to 4.25%. Inflation isn't falling as fast as some had hoped, opening the door for more monetary tightening to reduce demand and cool the pace of price increases. The UK's annual inflation accelerated unexpectedly back up to 10.4% in February, up from 10.1% a month earlier. Have a look at the chart. If you can't hear, have a look at the chart and you'll see. Restaurants and cafes, food and clothing were the biggest culprits, and they added to the rise most. In the US, the Federal Reserve has raised interest rates again itself. Despite some problems in the banking system, as you've heard, I think the Bank of Silicon Valley going west and the problems of Credit Suisse, that's called. However, the US has signalled that the need for more rate increases is now probably over. Okay, it's now probably over. So, what has been happening to UK mortgage rates? Rates are actually now dropping back. It's not clear whether this small increase in UK interest rates will push mortgage rates higher, but as in the US, in the UK there too is a sense amongst the professionals in that field that base rate increases are coming to an end, which is good news for us as purchasers. Average mortgage rates have dropped back over the last 3 months from the highs seen at the end of 2022. Kwesi Kwarteng and Liz Truss, thank you very much. Bank of England data shows the average 5-year fixed rate mortgage for a 75% loan to value has dropped to 4.38% from a high of 5.6% last October. What many borrowers will remember is the ultra low 1.2% mortgage rates reached in September 2021. That was the low point before rates started to increase again over 2022 as inflationary pressures built up. They were then added to by the mini budget last year. I mean, what can you say about that? What a disaster it was. Complete final quarter of the year, stopped purchasing. So, now try and remember, mortgage pricing is very complex. It's not as simple as one might think. How banks set mortgage rates is complex, and there is not a fixed relationship between mortgage rates and interest rates set by the Bank of England. You think interest rates go up, therefore mortgage rates go up. It's not the case. It all depends on where banks get their funding from in order to lend money out as mortgages, and therefore what the funding costs. They then add a margin onto this cost to reflect risk and a profit margin, which makes the mortgage rate. Hence we pay 1% more offshore because we're more of a risk. This is why higher loan to value mortgages attract slightly higher mortgage rates again. As there's more risk at lending at 90% loan to value than there is at 50%, more to an expat than there is to a resident. Banks use savings from depositors such as households and companies to turn into loans. Current accounts are also added to the funding pool. Banks also secure funding for mortgages from money markets. They can access fixed rate money for 2 or 5 years or longer. The cost of this money is called the swap rate. And the cost of swapping variable rate money to fixed money for a defined period. I didn't know that what a swap rate was until today. I knew what it did, but not what it was. The price of this fixed rate finance will be influenced by where markets believe interest rates will go over the period the money is secured for. So while base rates might go up in the short term, if the view is that inflation will slow rapidly and interest rates will fall, then this may result in the swap rates being lower than the base rates. Currently, the 5-year UK swap rate is 4%, fallen back from 5.3% last year, which means it's below the base rate. Banks will use a blend of sources as they price mortgages, and this means an increase in interest rates doesn't necessarily flow into a cost of new mortgages. And this is something we should all learn, because we ask so often whether this is the case. Borrowers on variable rate mortgages, where the cost is linked to the base rate, will see mortgage rate increase as the Bank of England raises rates. But for the majority on fixed rate loans, there'll be no change because the bank has priced it in. 4.75% throughout 2023. This is low by historic standards, but means the average buyer will still face an increase of $200 to $500 a month more in mortgage payments than at the start of 2022, when the rates were at these all-time lows. They don't expect the increase in the base rate to make much difference to the outlook for the housing market. Demand for homes is down on last year, but sales are still being agreed, albeit at a slower rate, 20% slower actually. People still want to move, and their households are resetting their plans in an environment of higher borrowing costs. Talk of a big price correction in home values, according to Zoopla, is overplayed. Okay? There would not be this humongous crash. And I know the gentleman always comments, will tell me it's going to be 40% fall, but it looks like he might be wrong. Okay? If you price your home sensibly, it will get some attention and you can negotiate on the final price. Next, single family housing. Is this the next buy-to-let boom area? According to Knight Frank research, it could well be. Single family housing remains in its early stages in evolution in the UK compared to more mature multifamily markets, but it's growing very rapidly. The number of complete and operational purpose-built rental properties in suburban SFH schemes stands at just shy of 10,000, which is up 11% in 2021. A further 9,520 SFH units are either under construction or a full planning permission. Knight Frank expect that this number will increase rapidly, supported by significant uptick in investments. Already in 2023, more than 450 million in SFH deals have been agreed, surpassing the full year for 2022. Okay, so what is it exactly? Unlike a traditional rental home, a single family rental shares no walls with other units and boasts its own access points. Instead of several homes, like a terrace, joined by hallways and lifts, a single family home provides more privacy and an independent living experience without the houses that can accompany ownership of a block or a terrace. It's big on the continent, it's big in the US, it hasn't quite got to the UK yet. Knight Frank have identified a further 8 billion of capital set aside to target SFH over the next 3 to 5 years, either through funds already secured or active ongoing fundraisers. There's a rising institutional investor interest in the SFH market, and it comes at a time when the supply of rental properties across the whole market is constrained, as you can see from the chart here. According to data from Rightmove, the volume of rental listings for houses across the UK in Q4 2022 was 42.6% lower than in 2017 to 2019, pre-pandemic averages, while RICS, market survey continues to report a fall in landlord instructions. Okay, good time to buy to let. Next, city centre living in the UK has returned to pre-pandemic levels, according to F&C. Activity within the letting market will increase as we head into the warmer spring months in the UK, according to Nikki Stevenson, Managing Director of Fine & Country. Stevenson pointed out that if the predicted increase in activity transpires, it will increase the level of activity in an already very busy rental market, with a shift back to city centre living and a rising interest in value for money and energy efficient homes. So grade C or above, economically friendly homes. She says the rental market continues to perform well and is expected to see a ramp up in activity as we transition from winter to spring. Rental prices remain high, supported by demand outstripping the market's persistent low stock levels. Again, she says, some in the industry have projected a 6% increase in rents by the end of this year, 2023, increasing to around 20% by 2027. She also observed that the market is seeing a resurgence in metropolitan areas as the hangover of COVID eases and city living returns, increasing demand for value for money homes. She pointed specifically at the Data Loft rental market analytics, which found 53% of properties let in the first 2 months of the year were apartments, similar to pre-pandemic levels. According to Stevenson, EPC ratings, Energy Performance Certification ratings, are moving up the renters' list of priorities and increasing inflation and living expenses cause concern. Finally, she says, as uncertainty surrounding energy costs linger, renters are increasingly prioritising energy efficiency. Statistics from Dataloft and the Property Academy reveal that 78% of renters consider the energy performance certificate important when searching for a property. And this is the truth. Grade C or above has got to be the way to go. Not so much old property, newer or refurb. So there we go. That's Market Wrap 145. Thanks for watching. In summary, mortgage rates may have peaked in the UK, flat for the year. SFH, investment option for the future, and city centres back to normal. Okay, it's possibly the place to buy in city centres now as opposed to the country. Now, please do like, subscribe. Hope you enjoyed it, and take care of yourselves. Don't forget, Paul Shearer podcasts far better than this. Listen to those. Cheers. Bye.